Well, welcome back to another episode of Finance Uncut. On today's episode, we have a look at part one of my investment thesis. Okay, so before we get started, just need to go through a disclaimer that this video is for education and entertainment purposes only. We are not giving financial advice. We're just a YouTube channel, so why would you listen to us in the first place? And look, the information in this presentation is no substitute for financial advice. So go see your own financial advisors, folks. All right, so this is going to be a two-part video. So first, I want to give you my macro thoughts. And if those of you have been following all my videos, you've probably already got a bit of a feel for where things are and where things are headed. And in this video, I'm just going to give an update with some updated information on the macro side of things. And then in part two, we'll break it down and we'll have a look at exactly how to put together, or how I'm putting together my portfolio, my macro outlook. So we can see that the change in real GDP has jumped up. So in the last quarter, we're officially out of a recession. However, you know, the Australian economy is still 4.2% below its peak. And if we compare that to previous recessions, it could take a while to return to that peak. So we are still in a deep, deep recession. And as you'll see, that really we haven't even had the recession yet, because the government have been spending so much directly into the economy, directly into households' back pockets. As we see here, the economy is still down 3.8% for the year, even though it has bounced back. Good news on the unemployment space. As you know that follow my video, I prefer to look at the Roy Morgan data than the ABS. Roy Morgan's got unemployment down to 11.9%, still very high, but it is lower and trending in the right direction. However, you'll see shortly some estimates that unemployment will rise into next year. So this could be about as good as it gets, but either way, it's definitely positive. Weekly payrolls. So job losses continue in the small to medium business sector, according to the ABS. Now, Centrelink data has seen only a small decrease in recipients. It could be argued that that's mostly driven by tightening of eligibility, but for millions, has seemed to peak when JobKeeper was, you can see here, so when JobKeeper began to taper, you can see in that SME space that more people are losing their jobs. So, as I was saying, there's some academic projections out there of unemployment to hit somewhere, and it is varied. So take it as you may, anywhere between 8.7 and 15.1% of unemployment when JobKeeper ends. So this is what I'm talking about. So as the government have spent directly into households, we really haven't felt the pain yet. We haven't had the pain of asset price falls or unemployment really biting, because everybody have either had those that have been affected with their employment have had mortgage deferrals. We've had rent, eviction. You can't throw people out onto the streets. However, that's now come to an end, and all these things are starting to roll off. So we really haven't felt the pain yet of the recession. So if these academic projections are anything to go by, 8.7 to 15.1% is going to be quite a nasty recession. Even at 8.7%, it's still higher than the ABS's current numbers. and that's really the baseline or the best case scenario. Um, However, when we have a look at household incomes, they haven't fallen, so the recession really hasn't yet begun for many people, which we'll have a look at in a sec. Right here. So if you have a look at the great lockdown and recovery period that we're in, the recession that we've had this year, you can see that incomes have actually surged and have remained elevated to what they were prior to the cerveza sickness. And if we compare that to the 2008 recession, which really in Australia we didn't really have a recession, incomes actually went down, and it took time to recover from that. Where this year incomes have actually surged because the government have, paid out so much in benefits to people. So you can see in this graph here that even to today, the government's benefits are still making up most people's income at the moment. And but this is all coming to an end. So the question is, do the jobs come back straight away? Do wages and salaries come back straight away? Because you'll see what's happened to wages this year as well, versus company profits. We'll have a look at that in a second. But this is where we haven't really felt the recession yet. And if the government stops the stimulus, which they say they are, and do we then get that pain? Do we then get that pain of that recession? Or will the government not turn off the taps? Because countries around the world aren't turning off the taps. And so basically the economy right now is up by central banks and governments. That when we end the fiscal and monetary stimulus, that the economy cannot stand on its own 2 feet. That it is now so addicted and so in need of government intervention and central bank intervention that the economy cannot stand on its own 2 feet. And do the government and central banks know this, and therefore will they just continue to print and risk devaluing the dollar? Anyway, we'll see. One thing that Australians have done well with getting the increase in government payments and having their expenses reduced so much because they had these, mortgage repayment deferrals and whatnot, is we have seen savings increase to, I think it was around 18%, which is very, very high. Also, the change in debt to GDP, you can see Australia right down the bottom here. Australia's actually improved their debt to GDP ratio. So households, and you can see that's households. So the dark blue, where government in Australia, look at that as a percentage there, government debt has just skyrocketed, and a little bit of non-financial corporates as well for Australia. But Australian households have actually been paying back debt. Credit card and personal loan debt is where Australians have really done well. So Australians have put some money aside in savings, and they've paid down some consumer debt. See that? So Australia still, we still got the gold medal when it comes to household debt to GDP. So we've got record level household debt to GDP. However, you can see that the trend has just come down slightly, where other countries, their trend is heading up. So yeah, but as I said, we still take the gold medal for high household debt to GDP. Here you can see lost GDP to total versus total government support. So to put this in context, in Q1, Q2, there was $38 billion in economic activity lost. Okay, so that's economic activity lost, 38 billion on the left, and on the right, and this is according to KPMG, there's been $257 billion in direct economic support that's been provided. So 6.8 times more than what was lost. We haven't yet felt the pain of the recession because governments have just absolutely gone brrr. Since the pandemic began, the government has provided that $257 billion in direct economic support. However, according to the budget, there's still another $250 billion in stimulus to come. And that's not including state and territory spending. So, for all this talk that, GDP's rocked up, we're coming out, we're recovering, economic boom ahead, folks. If that's the case, why is the government having to spend like just insane amounts into the economy? I guess it does look good, when you're throwing $500 billion at the thing. But when we compare this to the Rudd stimulus in the 08-09 years, you can see what the government is actually spending is just incomparable. You cannot compare it. And due to all this government spending, you can actually see that company profits have actually increased. So since December, gross company profits have increased 23.2% to a record of $117.4 billion for quarter three, with JobKeeper playing a huge role in the increase. Now, what's interesting is when we compare that to the GFC, company profits actually fell 19.6%. So once again, this is not a normal recession. It hasn't been allowed to occur. So I keep saying we haven't felt the recession yet. And as a consequence of this, you can see that company profits have risen this year while wages have fallen off a cliff. So JobKeeper has been a absolute boon for companies. Absolutely. Yet wages have fallen off a cliff. And in fact, wages have been on a downtrend for some time now due to globalization and other factors. Tremendous amount of home loans and business loans that are still in deferral. Yes, they are improving significantly from their peaks from earlier in the year. However, as we move into next year, and if that unemployment rate does rise between 8.7 and 15.1%, then there's going to be a lot of mortgage holders that won't be able to meet their repayments. They simply won't be able to meet their repayments. And so will the banks be able to continue to just defer? Well, it's actually in their interest to do so because they don't want a large pool of mortgage holders dumping their properties onto the market and pushing property prices down, because property prices go down too far, then banks' balance sheets become very interesting, to say the least. There could be some lenders that might find themselves in some trouble. But what we are seeing is lending commitments increase. So we have seen since Job Builder, once again, more government intervention. Job Builder or Home Builder or whatever it's called. We've seen a lot of first home buyers jumping in big time. Owner-occupied lending has really jumped up, and you can see that in the purple. So the value of dwelling lending commitments has risen, and therefore I do expect house prices to follow suit. I do. So house prices should tick up a little bit from here in the very, very near future. But once again, the home builder of 25,000 ends in December. It goes back to 15,000 for the first quarter next year. And at this stage, by the end of the first quarter, it's gone. So what we have done is pulled forward demand significantly. The problem is what happens beyond that forward demand. I believe the government will try to do all they can to get everyone taking the vaccine so that we can really open up the borders and just flood the place with migrants to try to fill that demand gap that is going to be behind this wave of new demand right now. I think that's the government's plan. Whether they do it or not, whether it works or not, I guess time will tell. The new loan commitments for housing, as you can see here, the month-on-month move. So owner-occupier and investors, excluding refinancing, is the highest it's been for some time. Housing. So the real big jump, you can see the middle line, the dark blue, owner-occupied, excluding refinancing, is the highest it's ever been. Highest it's ever been. So these are Aussies here at home. They're out there buying homes and leveraging up. Obviously, record low interest rates is pushing that up. Investment lending is slightly coming back a little bit, still very low, but it's all about owner-occupied and first home buyers in particular. And here looking at Queenslanders entering the property market. So first home buyer loan commitments, you can see we're on a vertical. We're just going up vertically right here. And if we compare that to the previous vertical spike in 2008 was when the Rudd government doubled the first home buyer grant back then as well, and just got a flood, brought that demand forward, got a flood of first home buyers into the market. But then after that, there was that, once you brought that demand forward, it then fell off a cliff. And so my concern is, can we get everyone vaccinated, open up the borders and bring a whole heap of migrants in to fill that demand that's going to be lacking there, pulled so much demand forward. It's going to be interesting times anyway. Australian building approvals up, as you can see. Houses is where people are going to. In fact, you can see that houses, that's the yellow line in the middle, it's the highest it's been for a couple of decades. So there is a lot of supply. So here's the thing, we're building a whole heap new homes. So we're going to have a lot more supply. We've brought forward the demand. What is going to happen beyond that? Because there's going to be more supply. Will the demand next year and the year after be there to continue to soak up this kind of level? So yeah, there's some real concerns there. Louis Christopher's Housing Boom and Bust Report 2021 just came out last week, and you can see the different scenarios that he has for housing, the different capital cities. For those of us in Brisbane, he's got about a 3.5% increase in property prices next year. And Louis, earlier this year, was definitely a bear. I think that properties were going to fall into 2021. He's now turned that around and thinks it's going to increase. And that's a lot to do with the government and central bank intervention into the market. And it's interesting that he's just done it for 2021. And also Martin North thinks that there's more, it's a bit more bullish in the short term, but it's really being held up by both government and central bank intervention at this point. And whether that demand, like I keep talking about, when all the stimulus ends, when all the enticements, inducements end, what's the demand beyond that, beyond this wave that we're currently in? And if we do start to get CPI increases, how long can the Reserve Bank keep interest rates at 0.1%? These are all things. I can say that a lot of our first home buyer clients have got pretty weakish employment. So, and their argument is, well, the repayments are kind of similar or the same as what I'm paying in rent. However, there's a lot more expenses when you own your home. There's other things like rates and insurance and water and all sorts of things on top, as well as maintenance and stuff like that. You then have to pay that out of your back pocket. And if there is rate increases of 1 or 2%, that's going to put significant pressure on these first home buyers that are buying with very little deposit at the moment. So they don't have much margin or much fat in the deal. And yeah, if either they lose their jobs, if the unemployment rate increases next year, or we get a bout of CPI increases over the next year or two, and the RBA have to increase interest rates, that's going to put a lot of pressure on these young people, a lot of pressure, financial pressure on these young people. And yeah, so it's a concern that I have. So we've got record low interest rates, yet at the same time, we've got record levels of mortgage. So mortgage stress is Martin North from Digital Finance Analytics. It's cash flow in versus cash flow out. So mortgage stress means that you've got more expenses going out than you've got cash flow coming in. That is not a good sign, and that cannot last forever. Is currently at 41.6%. So 41.6% of all households are in mortgage stress. Go back 2 decades, it was a bit above 10%. This is where we've gone with our debt levels, even though interest rates have just gone from what, back in 2000, just under 10%, all the way down to 0.1%. We've seen mortgage stress go from just above 10% to 41.6%. Think of that. Talking about, so at the same time, we've had the biggest tailwind for property with interest rates on a downward trend. We've been in a down cycle since the early 80s, but definitely since the early 90s. We've been in a downtrend in interest rates since then. So how much lower can interest rates go? Well, there's talk about going negative, going into negative rate territory, but that doesn't mean as a consumer that you get paid to take a loan. No, that doesn't happen. This is simply what the banks, with their excess reserves being held at the central bank, they've got to pay the central bank to hold those reserves there. That's what negative interest rates mean. So it just means that the banks don't want to hold those excess reserves. They're enticed to kind of lend it out. So, but banks also make money on that margin. They borrow short, they lend long, and so they need to make that margin. So you're not going to have, for a consumer, you're not going to have negative rates. When you borrow, you're not going to be paid to borrow. You will continue to pay. So how much lower can interest rates go, which is a tailwind for property? Okay, for property growth. I think we're at the absolute bottom. Perhaps they could squeeze a little bit more margin down. Rates could come down a little bit more. But whether it does or not, we're pretty much at the bottom of the cycle in terms of interest rates. And if we get CPI increases, which I argue that I think we will in the foreseeable future, then interest rates have got nowhere else to go but up. And so if you're looking at your debt position right now, and a large chunk of your take-home pay is going to mortgage repayments and other debt repayments, I would use this time to start preparing and start paying off some of those debts and get into a better position, because just in case CPI, and I believe it will, interest rates have basically bottomed. I thought I'd share this chart. So iron ore, as a percentage of exports, global exports, the globe relies on about 54% of Australia's iron ore. So we're the biggest exporter of iron ore in the world. Obviously, China is still the biggest buyer of that iron ore. The iron ore price is absolutely going ballistic at the moment, which is one reason why our dollar has increased quite a bit. The other reason is the fall in the US dollar. But let's watch this space on the Australia-China trade war, see what happens there. But interesting, China's banking assets to GDP is now at an all-time record. China is the biggest debt bubble in the world, and they've got the worst demographics moving forward outside of Japan. So everyone that thinks China is going to be this next great superpower, it ain't going to happen. China's demographics go down. It peaked, I think, in 2011 from memory. Their demographics go down for the next 40, 50 years. So China are not going to be the next great global superpower. And when their debt bubble pops, boom, see ya, good night. So going back to the dollar situation, so obviously a lot of, in fact, its record levels have been shorting the US dollar. And so the US dollar, the DXY has fallen quite a long way. And that's obviously another reason why our Aussie dollar has increased, because the US dollar has fallen, as well as the iron ore story there as well. So that's some of the things to look out for. Look, I do listen to some guys like Jeff Snyder, Brent Johnson, who are dollar bulls. Even the great legendary investor Jim Rogers actually does hold US dollars. He hates them. He thinks, at the end of the day, all fiat currency is rubbish. But he thinks in a crisis or when things start to get hairy, people will run to the US dollar. It is considered the safe haven, and there is a global demand for US dollars with the euro dollar system. And I'm not going to talk much in this video because we simply don't have the time. But he says that he thinks there will be, in the next little crisis when it's just around the corner, that the US dollar will rise, and he thinks it might even bubble, and that's where he'll sell his US dollars. And if that's the case, then our Aussie should fall. And to be honest, it makes sense when I look at that trade, and I do have a trade on for that. So I'm expecting that. Brent Johnson thinks it's going to happen kind of late 2021, maybe early 2022. Jim Rogers thinks it's even going to be a lot earlier than that, but I guess we'll wait and see. So as our Aussie dollar continues to rise, so we're seeing the RBA now expanding their balance sheet with almost $250 billion in new bond purchases over the next 6 months. With our Aussie dollar rising so much, really the only tool the RBA have got to try to lower the dollar, and they want to lower Aussie dollar because I think it's around 1 in 5 or 1 in 6 Australian jobs are reliant on exports. And so if we've got a higher Aussie dollar, it means our exports aren't as competitive. So the RBA wants a lower dollar so that we can continue to grow our exports. And so the question is, with the iron ore price just skyrocketing, and do they just increase their balance sheet, their buying of bonds to reduce interest rates, which means that the investors get less return on their money, so then there's a less demand for Australian dollars, etc., etc., etc. I think this is probably going to happen. I mean, every other central bank have been going crazy on the asset purchases, so I don't see why the Reserve Bank won't do so as well. And I think if our Aussie dollar starts jumping up above 75 US cents, if it pushes towards 80, the RBA is going to turn the taps on big time, because we just can't have that. That's going to hurt unemployment in Australia. And the RBA, our government's certainly interventionists, so they don't need much of an excuse to intervene into the economy. We're told that as interest rates fall, that's great for the economy and blah, 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 blah. Well, this chart right here disproves that. So you can see in blue the effective federal funds rate, as that has just gone down and down and down and down. Guess what? GDP, real GDP, has gone down as well. And why? Well, when you lower interest rates, then people, there's no you see people think there's no incentive to save, so they'll go and spend. No, what they do is they save more because they can't get a return on their savings. They can't get any interest on their savings. You got the baby boomer generation and older folk. They're just saving more. They're just putting more and more away to try to get some sort of return. If you're getting less on, $100,000, and I've said this before, to get, I think, what was it, about 12 years ago, if you wanted $50,000 a year in interest, you needed about 800,000 dollars in savings. Where today, because the interest rates are so low, you need like 8.3 million or something like that to get $50,000 a year in interest. So what do people do? They just save more and more and more, and so we have less spending, less consuming in the economy, and so therefore we have this GDP fall. So really, central banks are so stupid. They really don't understand economics. It makes me so frustrated. As I mentioned before, small businesses, we're seeing payrolls in Australia, also in the US. The small business jobs index is falling off a cliff and only going to get worse because, according to this poll, 48% of all small businesses are at risk of closing for good. And you can see the most impacted industries there are travel and hospitality, gym, fitness, beauty salons, consumer retail, and restaurants. And we're going to have some similar issues here in Australia with similar industries. Probably not to this extent, but at some extent we're going to see more pain, especially in the SME space. Well, we know Janet Yellen is now going to be the new Treasury Secretary under a Biden administration. And it's interesting what's going to happen there, being a former Fed chair. Now being the Secretary Treasury. MMT is all about merging the Fed and the Treasury together. Is this the first step of that? Well, you can see some articles here from both Jay Powell and Janet Yellen talking about how trillion-dollar deficits are unsustainable. Yellen saying deficits are unsustainable. The $20 trillion national debt, which is now over $27 trillion, should keep people awake at night. However, now they're saying, it's okay for the US to add all this debt, and now's not the time to worry about the federal debt. And Yellen says, worries about a deepening recession, don't worry about it. No worries here. So what is it? Should we be worried or should we not be worried? They really need to make up their mind. The Fed's QE bond purchases. So even though the top graph looks like, they're not doing as much. No, well, yeah, on a monthly basis they're not doing as much, but they are still buying, which means that it's going up. You can see in that red graph. So the big spike, but it's still going up. So the Fed is continuing to intervene into the market. And how do you get $1.2 billion in liquidity created out of thin air every hour? Well, here's how. For the first time in 90 years, the government is using a three-pronged approach to increase the currency supply. Now, we know how the Fed does it. The Fed, through quantitative easing, creates bank reserves. However, what's really happening this time is Treasury. And this is where I'm looking at the whole inflation debate, this whole CPI debate, is the Treasury part on the left. Direct injection of cash via stimulus checks and PPP loans. So $3 trillion direct fiscal stimulus. And I've shared this chart in other presentations from Lynn Alden. So you can see that QE, which is what the Fed has been doing, the red line, it stays within the banking system. So it's up to the banks whether they then use that as collateral to make new loans, or they can use it for payments within the central banking system. So they can actually use it to pay taxes and to pay other liabilities to other people who have got other organizations or banks that have got accounts with the Fed. However, it doesn't get, unless it's the banks create new loans and lend it into the economy, it actually doesn't have a impact in deposits at commercial banks, and therefore increasing the currency supply, and therefore creating the CPI issues. However, when you add the green, the government transfer payments, so this is where basically the Fed through the primary dealers is funding the majority of the fiscal stimulus, which is going directly into consumers' bank accounts. You can see that. So you can see that the green line, government transfer payments, has correlated with the Fed's asset purchases and total deposits. So we've got a huge amount of currency supply now out there sitting still. And this is where Jim Rogers says, as soon as the economy opens up, as soon as everyone gets a vaccine and demand comes back, as soon as demand comes back, all these newly created currency units are about to go into action. And that's where things are going to get nasty on the inflation front. We're already seeing it. So there's a split between goods and services at the moment. So you're seeing goods increasing while services are decreasing. And this is happening all around the world. This one here, Treasury Maturity Profile History. So this is a reminder that no one has more US dollar denominated debt coming due. So this is bonds that are that are expiring or maturing. So the government need to pay this back. So 37%. So you can see down the bottom. This is in the next 12 months. There's 37% of $20 trillion worth of government bonds due in the next 12 months. So $7.4 trillion is due that the government has to pay back. So what does Uncle Sam have? Well, there's three options here. So Uncle Sam can default, crowd out global US dollar borrowings and crash the stock market and economy, or print the currency. So what three options do you think are going to happen? Do you think they're going to default? No, I don't think so. Do you think they're going to crowd out the global US dollar borrowings and therefore crash the economy and the stock market? Don't think they're going to do that either. Print the money, or print the currency? I think so. That's what they've been doing. I think they're going to do it again. The foreign share of ownership in the Treasury market has declined to its lowest level since the turn of the century. So if people around the world and governments and big pension funds and all that are going, oh, yeah, we don't want to buy as many US government debt as we used to, then who's buying it? Well, the Fed. So in essence, they're kind of quasi monetizing the debt, monetizing the government debt, because they're spending it directly into the economy, creating these new currency units and deposits at commercial banks. Looking at the Treasury yield curve, it's now the highest in 3 years. So this is the spread between the 2 and 10 year. So this is where banks start to make profits, but it's also a leading indicator of what? Inflation, CPI. The 2-year bond curve is heading up. So the curve is steepened. This is rising inflation expectations. And volatility is at the lowest it's been that I've seen in my career. And I'm just starting to think that now might be the time to go long volatility. I guess the big popular things happening right now and a hedge for inflation is Bitcoin. Now, I don't talk about Bitcoin much because if you even dare to ask a question about Bitcoin to Bitcoiners, you'll be attacked. You'll be shot at. I got to be honest, the behavior I see from Bitcoiners, to me, it's like a cult. And so I am very anti-Bitcoin just because of Bitcoiners. I actually like the idea of Bitcoin being a decentralized monetary type system. I like it, all the aspects. Coming from a Austrian economic point of view, I love everything about it. However, I do have some concerns about it, and whenever I ask those questions to Bitcoiners, they get extremely nasty. And so for me, that puts doubts in my mind. If all these Bitcoiners are so cultish like this and just get so aggressive. Why do they need to do that? Like, I'm a gold and silver investor. I couldn't care less whether people buy gold and silver or not. I couldn't care less whether you think it's an ancient relic or not. I know gold and silver, and I've done well in it in the past, and I'll do well in it in the future. I don't understand the Bitcoiners, their nastiness, their almost cultish behavior. But just take note that with the Bitcoin wealth distribution, 4.1% of addresses own 96.5% of Bitcoin. So therefore, 95.89% of addresses own only 3.4% of Bitcoin. Just a thing there. I just thought I'd throw this one in from Wayne Duggan. No matter the bull case, Bitcoin is still rat poison. Jim Rogers, Warren Buffett, obviously they're not big fans of Bitcoin either. Jim Rogers did a really good interview recently on, I think it was Macro Voices, where they're discussing the whole Bitcoin case, and he makes some great points, and that's kind of my concerns, yet no Bitcoiners can explain it without going into the whole threats and stuff. Anyway, another thing that people think, well, if there's going to be inflation, then invest in the stock market. However, when you look at the Dow Jones in real terms, it's so inflation adjusted, look at the 70s, look at the 60s and 70s. There's a big crash in real terms. And measured against gold, the stock market crashed in the 70s. And even in nominal terms, there was a period, I think it was from 1972 to 74, you can go and fact check me. There was a period of about 2.5 years where in nominal terms, there was a crash in the Dow. The stock market went down. So no, the stock market is not a great place to store your wealth, so to speak, in an inflationary environment. Stock market now. So, between 1952 and 1988, what was the source of the stock market gains? It was economic growth. 92% was economic growth. This is fundamentals. This is real wealth. But since then, 1989 to 2017, I'd say now, if we added 2020 into here, that economic growth would be very, very small percentage, and it'd be all transfer from wages. So now we've just got next to no economic growth, which is causing the stock market gains. It's all just people piling in, just liquidity being thrown into the market, and a lot of speculation. People don't really care about valuations or fundamentals anymore. Right now, equity ETFs have lured 81 billion as global stocks jump most since index began. You can see that that's the most, in living history. So this is a liquidity-driven boom in the stock market. There's no such thing as fundamentals in the stock market. There's no correlation with the economy. That is completely broken right now. So, folks, if you're investing in the stock market right now, understand that you're not investing on anything other than gambling. It is literally a casino now. There's no correlation between the stock market and the economy. There is no fundamentals. You're simply investing in the stock market based on pure speculation, hoping that the liquidity continues to pile in, because when the liquidity slows down or stops, there's no fundamentals behind it. Look at this chart. So this is the number of calls. So the call option index. So the amount of people buying call options. There's a bubble. There's a bubble. Everyone thinks the market's only going up. The market is now got a market cap of $100 trillion. First time in history. Warren Buffett's favorite market indicator nears record high, signaling stocks overvalued and a crash may be coming. And our market cap to GDP, which is now over 180% of market cap to GDP. Basically, no protection needed. Central bank guaranteed. It's the biggest asset bubble ever. And even at the peak of the dot-com mania, uh, market sentiment was not as euphoric as it is today. The dot-com bubble, so this is the right X ratio is market sentiment. It's the highest it's ever been right now. In the greatest lockdown, the greatest pandemic, the greatest recession we've had since the Great Depression, we've got market sentiment at all-time highs. Because once again, it's not based on any fundamentals. This is Tesla's revenue. Skyrocketing. Their multiples are just skyrocketing. Their valuations are just skyrocketing. They don't make any profits. They don't have any earnings. So you might think, okay, well, if that's the case, then they're just reinvesting everything into R&D, into growth, into blah, blah, blah. But their revenues must be skyrocketing. Their revenues are rubbish. Look at their revenues. From Jesse Felder, the original tech bubble in 2000. How many of the 10 largest market cap tech stocks beat the market over the next 10 years? 0. Not one. And this is the thing. When you buy stocks at such high multiples, then your rate of return for the next decade is very, very low. That's why you don't, the buy low, sell high mentality. You don't buy high and sell low. Opportunity or the numbers are in your favor when you buy low, that you're going to get good returns over the next 10 years. And I make this comparison to, say, blackjack 21. Now, you might land on 19 or 20 and you go, hit me. Now, you might get 1 or 2 and you get that blackjack. You might do that once or twice, maybe 3 times if you're really lucky. But if you do that over the long run, you're going to lose all your dough. All your dough. But if you get, land on 8, 5, 6, and you hit me, then you're gonna get you're gonna have over the long run, you're not going to lose as much. So it's just really a numbers game there. The red bars in this chart below show one of the more extreme syndromes: overvalued, overbought, over bullish conditions that one can define. Okay, so on all technical technical metrics, it shows the most overvalued market, overbought, over bullish in history. And the CAPE ratio, so this is the Shiller CAPE ratio. Only once has it been higher, and that was during the dot-com bubble. Okay, so just on every single metric, other than this one, we are at record highs. This is the only one that's metric that the dot-com bubble was higher than where we are. Look, no extremes here, folks. No extremes whatsoever, except that markets are 144% above the long-term trend. Look at that on the right-hand side. So on this metric, the markets are 144% above its long-term trend. What are your odds that this continues up and up and up and up over the long term? Zilch. In the short term, yeah, maybe. Pump more liquidity in, boom. But over the long term, good luck with that one. So obviously with all this inflation that I think is going to happen in CPI, in the goods sector, goods and services, what's the place to go? Obviously, gold and silver have been that hedge against inflation in the past, except that's not quite true, is it? If you follow my videos, there's been times from 1980 through to 2000, we had inflation every single year during that time. Yet gold went from 800 to 200. Yet they say we've had no inflation over the last 20 years. Yet we've had gold go from 200 to 2000. So there's actually other things that for gold, and I've mentioned it before, things like negative real rates, obviously the devaluation of currencies. There's other things like the debt loads that we have. With gold, when you own the physical gold or physical silver, you've got no counterparty risk. No counterparty risk. That's so important. So when I look at, we can see the gold price has actually bounced off its low. So we've got the 5-year real yield has increased, and this has been a good. So I look at real yields. Forget inflation for gold. I look at yields, real yields for gold. So when you have a negative real rate, then that's bullish for gold. When you got interest rates at 10% and inflation's at 2% or CPI's at 2%, why would you hold gold? Stick your money in a bank and get 10%, and it's actually increasing in purchasing power by 8%. So here with the Fibonacci, you can see that gold was falling down, but it's since bounced off that Fibonacci level. And here you can see it, that gold has bounced off that, and silver as well. And so this says to me that gold and silver has shaken off all those, say, the Robin Hood buyers, or people who don't really know nothing about gold and silver, but just jumped onto it because, it's going up. So with the downturn that it's had, it's shaken off all those, I'm jumping out, it doesn't make sense for me to hold this anymore because I don't understand the macro and the fundamentals. And so they've gone, which is good. That's healthy. So we've now got, I guess, those that understand the market, and for it to bounce back up, this is nice. And what's really interesting to me is that silver, which is normally more volatile than gold, actually did well in this most recent pullback. So back in March, silver actually fell more with that silver to gold ratio. It actually fell quite a lot. Only fell 10% in this little downturn, and since bounced back quite nicely. High-grade copper prices are now back up to very high prices, and I still look. I'm buying copper. I still think copper at these prices are fantastic. Moving forward, you'll hear my thesis in part 2. And why I'm buying gold, obviously gold and silver, but also copper as well. And ultimately, I'm buying commodities. Commodities in general have never been this cheap. There's the commodities index chart here. I've shared this before. Commodities is something I'm very bullish on over the longer term. Now, could commodities fall even more? Yes, they could in the short term. But instead of worrying about trading and timing things perfectly, I'm just buying cheap assets right now. And so as we wrap up this part 1 of the presentation, I want to thank you all for listening. This is the macro theme, so you've got a bit of my ideas on things. From previous videos, you'll get a clear picture on where I see the economy, where I see the outlook. And in the next video, I'm going to discuss how I'm building my portfolio based around this thesis. I'm going to go into a lot of detail, and so I think you're going to really enjoy. Don't miss the next one. Don't miss part 2, because you're really going to get a lot of value and a lot of detail out of how I'm putting together my portfolio. So thanks everyone for joining me. I'll see you again on the next episode of Finance Uncut.